As the market is currently closed this Saturday afternoon, May 16, 2026, NUBURU ended its last active trading session yesterday, Friday, May 15th, at a closing price of exactly $0.204 per share, marking a slight intraday gain of 0.89% on the day. While a casual glance at a standard retail trading application might make this look like a minor, quiet stabilization for a microcap stock, the underlying reality is a high-stakes corporate drama. Just 24 hours ago, management disclosed a critical financial restructuring agreement alongside a fresh regulatory warning from the exchange. While most casual retail investors looking at basic online investing forums assume this penny stock is simply fading away into obscurity, institutional tracking shows that volume surged past 10 million shares in yesterday's session alone. That is nearly matching its entire multi-month average volume in a single day, signaling that large-scale participants are actively repositioning themselves behind the scenes. The common expectation surrounding this business is that it is a typical microcap tech firm drowning under the weight of severe balance sheet deficiencies and looming delisting threats. After all, the exchange just issued a formal notice because the company's multi-year net losses triggered a strict $4 million minimum equity requirement that they simply did not meet at the end of the previous fiscal year. However, the reality hidden inside their latest financial disclosures reveals an absolute whiplash in their net asset position. Management just announced they expect their upcoming quarterly report to show stockholders' equity rebounding to approximately $3.2 million. This represents a massive $18.4 million balance sheet recovery compared to the deep deficit they carried at the end of December. This massive structural shift completely upends the narrative that the business is facing an immediate, unmitigated shutdown, forcing serious participants to look much closer at the asset's true survival probability. When individuals look for investment help on modern platforms or manage their own portfolios through a self-investing model, they often look at mega-cap pillars like Tesla stock or Apple stock to find stability. But when you step into the world of distressed microcaps, the rules of engagement change entirely. The recent volatility in this security has been fueled by an intense tug-of-war between devastating dilution and a radical strategic pivot. Just this week, the company executed a massive exchange agreement with Indigo Capital, allowing the conversion of up to hundreds of thousands of preferred shares into pre-funded warrants. On one hand, this move helps clear toxic liabilities and repairs the balance sheet to satisfy exchange requirements. On the other hand, it floods the market with millions of potential new common shares, creating an intense dilution risk that explains why the price is pinned down near 20 cents, despite massive balance sheet improvements. To put this structural tension into perspective, consider how the broader market handles microcap technology compared to traditional institutional growth engines. For instance, when retail traders accumulate NVIDIA stock on popular choices like the Robinhood app, they are paying a premium for predictable, compounding cash flows and clear global dominance. When an investor buys into an individual brokerage account looking for microcap asymmetric upside, they are essentially buying a highly volatile option on corporate survival. The trading action over the last few sessions shows that despite massive intraday swings dropping as low as 18 cents, a massive block of buyers stepped in to clear out the sellers before the weekend. This institutional absorption suggests that someone is betting heavily that the company will successfully cross its next listing compliance hurdle by late October. Let us pause for a moment to gauge the sentiment in the room. Go ahead and comment below how many shares of NUBURU you currently hold in your portfolio, or if you are choosing to avoid this level of microcap volatility entirely. It is always fascinating to see how many people are willing to allocate capital to high-risk defense turnarounds versus keeping their money strictly in diversified index funds. Understanding what this business actually does requires separating its past identity from its current structural transition. Founded a decade ago, the enterprise initially focused on developing high-power blue laser technology for industrial manufacturing, arguing that blue light wavelengths absorbed materials much faster than traditional infrared options. But standard industrial laser markets are capital-intensive and highly cyclical. Realizing that cash burn was destroying the equity base, management initiated a total strategic pivot into a dual-use defense and security platform. Today, they are repositioning their entire product suite toward directed energy systems, counter-drone technologies, and electronic warfare assets. They are actively pitching portable laser systems to international government defense organizations, aiming to capture a slice of the rapidly growing multi-billion-dollar counter-unmanned aerial vehicle sector. This business model shift explains why the financial metrics look so bizarre to traditional analysis tools. If you pull up the security on an advanced interactive brokers platform, the trailing negative earnings and historical cash drainage look catastrophic. But if you analyze their fresh operational updates, you see early signs of transactional traction. The company recently reported hundreds of thousands of dollars in new billings and executed defense orders, including a deployment order for a proprietary portable laser system with an APAC region state-owned enterprise. By shifting away from standard industrial commercialization and moving toward funded government defense prototypes, they are trying to replace high retail marketing costs with large, lump-sum government contracts that provide much better structural margins. When managing an intelligent portfolio or reviewing asset allocations across large corporate platforms like Fidelity Investments, the central question for a stock like this is always terminal survival. The exchange gave the company until October 29, 2026 to prove they can permanently sustain their equity requirements. management claims that their upcoming June quarterly filing will officially show them crossing the $4 million threshold, which would fully resolve the current delisting designation. If they achieve this, the massive gap between their current microscopic market capitalization and their improving book value could close rapidly, forcing a violent short squeeze. However, if their defense contract pipeline stalls or if their partnership deals take longer to fund than expected, the continuous dilution from their warrant agreements will completely wipe out any remaining retail equity. Looking ahead, the future outlook for this asset rests entirely on a knife-edge balance between operational execution and capital structure decay. In a best-case scenario, the company successfully solidifies its pending defense acquisitions, secures final funding for its prototype builds, and uses its improved balance sheet to regain full exchange compliance. This would shift the asset from a speculative penny stock into a legitimate microcap defense contractor. In the worst-case scenario, the structural dilution from the Indigo Capital agreement acts as a permanent ceiling on the share price, leaving retail investors holding the bag while institutional debt holders convert their positions at a steep discount. When we synthesize the core components of this situation, the contrast between market expectations and corporate reality becomes undeniable. The common market narrative labels this security as a failing penny stock on the verge of being kicked off the exchange. The deeper reality reveals a company that has managed to engineer an $18 million balance sheet recovery in less than 2 quarters, possesses a clear regulatory pathway until late October, and is actively transitioning into a high-margin defense sector. It is an incredibly dangerous, highly speculative environment where capital can disappear in a flash, but the structural steps taken behind the scenes show that management is fighting aggressively for survival. Whether this corporate transformation succeeds or falls victim to institutional dilution remains the ultimate test for anyone watching this asset move forward. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.